Good morning, this is Connor from 0DTE Traders, here to present the week ahead for November 24th, 2025. To start the week, GEX, which measures dealer gamma exposure, is negative, 540 million notional, trading below both transitional levels, 66.65 gamma and 66.70 flip. The flip is our main transitional level, and this is essentially where dealer hedging shifts from destabilizing below to stabilizing above. And it's generally visible if you look at the SPX notional gamma chart. As you can see, all strikes above positive, that is supportive for the market price. All strikes below negative, that is destabilizing for the market price. Now, another way to put it is above the flip, bulls are in control, expect lower volatility. Below the flip, bears are in control and expect more volatility. So that flip level is going to be the key level here for bulls to break to begin shifting control in their direction. Option expiration is now behind us, and given the negative gamma observed during the final week of OPEX, this cycle has been classified as negative gamma. So essentially what we do is track the SPX monthly options expiration, as there tends to be a very consistent patterns in the week of option expiration and oftentimes in the week following option expiration. So what we do is classify these into three categories: negative gamma, positive gamma, and neutral. And this depends on really that gamma index going into option expiration. So really focusing on the final week to classify the cycle. But the point is here, after option expiration, we tend to see pivot points in price. So you can see a number of examples here where we do see sort of a pivot or sort of a pause, a consolidation in the price action. I've broken this chart down so many times on these videos, so I'm not going to go over that in depth here today. I'm more so going to explain sort of the dynamic why. So gamma 101, when you're in negative gamma, you're trading below those transitional levels. Dealers chase deltas. So as the market falls, dealers who are long calls and short puts sell stock to hedge. So this amplifies the downside. Okay, this is why we're seeing these huge downside moves. Conversely, as the market rises, they buy stock to hedge, amplifying upside. This is also why we've seen some big upside moves last week. Matter of fact, some of the biggest rallies occur from a negative gamma state due to the presence of these feedback loops. Now, what happens post-option expiration is this dynamic often eases as options lose sensitivity. So recall, options are most sensitive for at the money closest to expiration. If you're a 0DTE trader, you know exactly what I'm talking about. But post-OPEX, when you get the loss in sensitivity, less active dealer hedging, this often creates conditions for short-term counter moves and reversion in volatility. Additionally, the VIX is currently trading at 23. A 23 VIX implies roughly a 1.5% one-day implied move, while a VIX of 29 implies about a 1.8% implied move. Now, how do you determine this? Take the VIX, divide by 16, and that will give you an approximation of what the VIX is implying on a daily basis. The point is here that these levels are very hard to sustain without a steady stream of events propping up implied vol. And this underscores the mean reverting nature of implied volatility. So if you look at the VIX on the daily chart, you can see we get these spikes, they peak, and then we get a hard contraction in volatility. Because as soon as, let's say a VIX 29, 1.8%, if this stops to be realized in markets, traders are going to perceive an edge, they're going to sell volatility, they're going to monetize their puts, and that's what's going to create those squeeze rallies on the upside. Okay, so there's a lot of underlying dynamics that create those feedback loops, those charts, those sharp squeeze rallies, those parabolic declines, not just from a gamma perspective, but volatility is a major variable in terms of option pricing. So if you do get a huge contraction in volatility, all options are going to get repriced lower, as all options have a lower probability of expiring in the money. From a dealer's perspective, this is going to force buying, and that's what's going to take the market much higher. So we just need to be aware that those dynamics are in play here. There is a lot of fuel for an upside squeeze. Does that occur? I don't know. We want to focus on the VIX levels. So I'm going to reiterate those here. They're really unchanged from last week, but we got 17.3, 18 on the downside, 19.5, 20, 22, 23. And this is probably the most significant level because this did cap vol for much of this year. Of course, we had some breakouts, and in April we went to like 50, 60. So those events do occur, but they are rare. So we really look for vol to really get back below that 22, 23 zone. Above that, there is potential for more panic, with resistance at 25, which we did close below here on Friday, followed by 29, 30. And a break of 30 would most certainly be an indication of panic put buying. To further touch on the panic put buying last week, if we look at the SPX CBOE put call ratio, it's at 1.44. Very elevated. So a lot of participants bought puts at elevated implied vol levels. So this means if we do see a rally in the SPX, implied vol moves lower, a lot of participants are going to be sitting on unrealized losses on these puts, which oftentimes forces capitulation, the removal of the dealer hedge, and consequently buy flows in the SPX. So you always want to keep an eye, I would say, on the put call ratio. However, the VIX is, I would say, the best proxy for that, right? Because VIX is measuring long options in the SPX. So when you get a spike like that, I think we moved up on Thursday, 45% trough to peak in the VIX. That's a clear indication that there's very strong put demand. Transitioning to the SPX chart on the 1 hour time frame, the trend remains down. The 50 period moving average in white is also down sloping. That's an indication of a downtrend. Support shows at 65.80, 65.75. This was a zone that held for much of last week. We did break below it here temporarily, end of day Thursday, early Friday, but there was demand below that zone. 65.21 is the previous week's low, so a break does imply an outside week. That is a trend continuation indication, with support below at 6,500. That is our put wall and our lower bound. Below that, the implied low sits at 64.51. That is the 4-day implied move because Thursday is closed for Thanksgiving. The 4-day implied high sits at 67.51. I believe that's about a 2.28% implied move this week, so vol still quite elevated. But the main level here for the bulls is going to be that transition at 66.65, 66.70. That's the zero gamma flip levels we talked about. And then beyond that, we do have a down sloping trend line that could potentially act as resistance. Now, we don't necessarily know where these trend lines are going to come and play. That depends on time and velocity, but I would mark that off as a potential resistance level. That means potential reject or a break, which would be a bullish indication, opening the door to the next resistance zone of 67.70, 67.75. And we can see this is quite significant here, particularly on Thursday where we had that gap up. We ran into this level and then, gap and crap scenario. Additionally here, keep in mind these levels we're quoting here, particularly these transitional levels, put walls, call walls, etc., can change on a day-to-day basis. So if you're a member, make sure you're checking the dashboard for the most recent information. Even though we're 0DTE options traders, it's important to have a finger on the macro, understand what's moving price, what's top of mind for participants. And the primary variable here has been the potential rollover in the liquidity cycle and the hawkish pivot from Fed Chair Powell, as he emphasizes prioritizing the inflation component of their dual mandate. Rate cut probabilities for December have been very volatile, dropping to a low of 30% last week. Since then, on Friday, we saw a big bounce, pricing in now about 70% probability of a 25 basis point rate cut for December. This is following some dovish comments by Fed Williams. However, something we always need to ask when it comes to Fed policy, is it too little, too late? Historically, the Fed and Fed Chair Powell in particular has had a very poor track record in timing policy. I want to highlight some of Powell's policy mistakes. Over-tightening in 2018, delaying rate cuts in 2019, early pandemic response in 2020, underestimating inflation in 2021, and gradual tightening in 2022. Additionally, rate cuts take 12 to 18 months to fully affect the economy, meaning any current easing may arrive too late to offset slower growth. The White House estimated a 2% reduction in Q4 GDP, impacted by the 43-day government shutdown. Now, in the short term, rising probabilities of a December rate cut could boost trader sentiment, but I would expect continued volatility in these odds and something that should be watched closely day over day. This week, Wall Street will get a brief pause for Thanksgiving, with the markets closed on Thursday and many traders taking Friday off as well. But we are not without data on the economic front. Traders will see delayed September retail sales and producer price index, the PPI data on Tuesday, followed by durable goods on Wednesday. Earnings season is winding down, but major reports are still expected from names like Alibaba, Dell, and Deere. If you want to join the team and learn how we approach 0DTE options trading, now is the perfect time. Take advantage of our Black Friday Thanksgiving sale by using code 0DTE20 at checkout to get 20% off.